Olympia and York Developments was, at the peak of its expansion in the late 1980s, the largest private real estate developer in the world. The company was founded by the Reichmann brothers, Paul, Albert, and Ralph, Orthodox Jewish refugees from Hungary who had built a tile importing business in Toronto into a global real estate empire through a combination of contrarian timing, patient capital, and an institutional scale of ambition that distinguished them from every other developer of their generation. Their projects included First Canadian Place in Toronto, the World Financial Center in Lower Manhattan, and Battery Park City, developments that had established Olympia and York as the preeminent commercial real estate developer in North America by the early 1980s. In 1987, Paul Reichmann made the largest single real estate investment in the history of the British Isles, the development of Canary Wharf, an 800-acre former industrial docklands site in East London, into a major new financial district that would absorb the overflow of financial services demand that the City of London could no longer accommodate within its medieval street plan. The project would cost approximately £7 billion. In May 1992, Olympia and York filed for bankruptcy protection in Canada. The filing was the largest real estate bankruptcy in the history of the world at that time, a collapse so comprehensive that it engulfed not only the Canary Wharf project but the World Financial Center in Manhattan, the First Canadian Place in Toronto, and the full breadth of the Reichmann brothers' North American portfolio. The forensic entry point for this case is the relationship between the two projects at the center of the collapse, the World Financial Center in Manhattan and Canary Wharf in London, because those two developments document a specific pattern of contrarian real estate genius applied in sequence, the first successfully and the second catastrophically, by the same developer at the same moment in the global credit cycle. If this is your first case file from this channel, subscribe now, because every episode adds one more layer to what you are about to understand about the architecture of institutional failure. The World Financial Center was developed by Olympia and York in Lower Manhattan's Battery Park City between 1985 and 1988. The project was a contrarian bet of extraordinary scale and precision, a commercial real estate development on land that had been created from Hudson River landfill, in a location that the conventional real estate market had dismissed as too far from Midtown Manhattan to attract the financial services tenants that a major commercial development required. The contrarian thesis proved correct. American Express, Merrill Lynch, Lehman Brothers, and Oppenheimer anchored the development at rental rates that validated Olympia and York's assessment of the location's potential, and the World Financial Center became one of the most commercially successful office developments in New York City's history. The success of the World Financial Center gave Paul Reichmann the institutional credibility and the financial capacity to pursue Canary Wharf, a project whose scale, complexity, and dependence on a single transformative bet made the World Financial Center look modest by comparison. The Canary Wharf thesis was structurally identical to the World Financial Center thesis, a contrarian assessment that a location dismissed by the conventional market as unsuitable for major commercial development would, through a combination of superior physical infrastructure and patient capital, attract the tenants that the conventional wisdom had assumed it could not. The covenant that the Canary Wharf development did not read carefully enough was the one embedded in the difference between the two markets. The Manhattan financial services market of the early 1980s had been absorbing the expansion of American financial institutions at a rate that created genuine demand pressure in the existing office stock. The London financial services market of the late 1980s was absorbing the expansion of international financial institutions following the Big Bang deregulation of 1986, but at a pace and with the geographic specificity that the Canary Wharf thesis had overestimated. The tenants who had made the World Financial Center viable were American institutions with no alternative to Manhattan. The tenants who were supposed to make Canary Wharf viable were international institutions with the choice between the City of London and Docklands, and many of them were not making that choice at the pace or the price that the development's debt service required. At what point does a developer's track record of contrarian success become the source of the overconfidence that produces the next failure? Leave your analysis in the comments below. The appraisal methodology that justified Olympia and York's investment in Canary Wharf shared the foundational error documented across this channel's archive, but expressed it through the specific dynamics of the late 1980s London property market in a way that makes this case uniquely instructive for understanding the international dimension of real estate cycle risk. The stabilized rental rate projections for Canary Wharf were calibrated to the peak of the London commercial property market following the Big Bang deregulation of 1986, a period during which the City of London's vacancy rates had fallen to historic lows and rental rates had risen to levels that made alternative locations appear commercially viable for the first time. The projection treated that market condition as a durable baseline rather than as a cyclical peak, applying capitalization rates that reflected the compressed yields of the late 1980s expansion to a stabilized income projection that was itself a product of the same expansion. The specific risk that the projection had not adequately priced was the cyclical relationship between London financial services employment and the rental demand that Canary Wharf's development required to be commercially viable. London's financial services sector in 1987 and 1988 was absorbing employment at a rate driven by the combination of Big Bang deregulation, the expansion of European capital markets, and the globalization of investment banking that the 1980s had produced. That employment expansion was cyclical, not structural, and the credit market contraction that began in 1989 reversed it with the speed and severity that the Canary Wharf projections had not incorporated as a planning scenario. The appraisal had modeled a stress scenario involving a moderate reduction in rental demand from its peak projections. The actual demand contraction was not moderate. By 1991, Canary Wharf had achieved occupancy rates significantly below the stabilized projections, and at rental rates that reflected a market in which the City of London's existing vacancy had expanded enough to provide competing space at prices Canary Wharf could not match without destroying the economics of the development entirely. The debt service on the Canary Wharf construction financing required occupancy and rental income at levels the market of 1991 and 1992 was not producing. If the forensic analysis this channel conducts is changing how you read real estate headlines, the like button is how the algorithm knows to send this case file to the next analyst who needs it. The Olympia and York bankruptcy of May 1992 produced one of the most complex multi-jurisdictional restructuring proceedings in the history of commercial real estate, involving assets in Canada, the United States, and the United Kingdom simultaneously, creditors across 3 legal systems with different insolvency frameworks, and a total liability figure that required years of proceedings to establish with precision. The Reichmann brothers' response to the financial crisis that preceded the bankruptcy filing reflected a pattern documented in multiple previous case files: a sustained effort to negotiate directly with the major creditors to restructure the debt without triggering the formal insolvency proceedings that would transfer control of the assets to a court-supervised process. Those negotiations involved more than 90 lenders across multiple countries, a coordination challenge whose complexity made the conventional restructuring approaches applied in simpler single-asset defaults inadequate. Paul Reichmann's personal involvement in the creditor negotiations was extensive and sustained. His credibility as a developer, his track record at the World Financial Center and his other successful projects, and his willingness to invest personal capital in the restructuring process gave the negotiations a dynamic that a less prominent developer's bankruptcy would not have produced. The negotiations ultimately failed to produce a voluntary restructuring adequate to address the scale of the Canary Wharf financing shortfall, and the May 1992 filing transferred the restructuring process to the courts in Canada, with parallel proceedings for the London assets managed under British insolvency law. The institutional denial in this case was not the denial of financial reality by a developer who refused to acknowledge the severity of the situation. Paul Reichmann's communications with creditors during the restructuring period documented a clear understanding of the financial position. the denial was the assumption, sustained longer than the financial position warranted, that the Canary Wharf development's long-term commercial merit was sufficient to support a restructuring that preserved Olympia and York's ownership and control of the asset. That assumption was not irrational. Canary Wharf did eventually become the major financial district that the Reichmann thesis had anticipated. The development was acquired out of the bankruptcy by a consortium that included Paul Reichmann himself, who retained an involvement in the project whose long-term commercial vindication he had predicted. Canary Wharf emerged from the Olympia and York bankruptcy proceedings under new ownership that included a consortium of banks and a restructured equity position that eventually became the publicly traded Canary Wharf Group. The development achieved the commercial success that the Reichmann thesis had projected, on a timeline approximately a decade longer than the original financing structure had been designed to accommodate. CBC, Citigroup, Barclays, and dozens of other major financial institutions eventually occupied buildings in Canary Wharf, making it the second major financial center in London and validating the contrarian thesis that Paul Reichmann had pursued at the cost of his family's company and his personal fortune. The World Financial Center in Manhattan, now known as Brookfield Place, continues to operate as one of the most commercially successful mixed-use developments in Lower Manhattan, anchored by the financial services tenants who had made the original development viable, and surrounded by the broader Battery Park City development that Olympia and York's contrarian investment had helped catalyze. What the Olympia and York case reveals in the context of this channel's 27 case archive is the specific risk of sequential contrarian bets in real estate development, where the success of the first bet creates the financial capacity and the institutional confidence to pursue the second bet at a scale and with a debt structure that the first bet's financial model cannot support. The World Financial Center was contrarian and correct. Canary Wharf was contrarian and correct in its ultimate commercial outcome. The difference between the two was not the quality of the underlying thesis. It was the timing of the credit cycle, the scale of the financing required, and the duration that the development needed to achieve the occupancy that validated the thesis. The World Financial Center's financing was retired by the revenue the development generated. Canary Wharf's financing required a market that took a decade longer to arrive than the debt service calendar had allowed. Paul Reichmann lost his company. He eventually recovered his involvement in the project. The Canary Wharf towers are still there. The Docklands Light Railway still runs to them. The thesis was right. The financing was not. If this case file changed how you evaluate the relationship between contrarian real estate genius and the credit cycle timing that determines whether that genius produces returns or bankruptcy, subscribe to this channel, because the next case examines what happens when the thesis is correct, the timing is correct, and the failure comes from a variable that neither the thesis nor the timing could have predicted. And in the comments, given the specific difference between the World Financial Center's tenant base and Canary Wharf's tenant base, what specific pre-leasing covenant in the Canary Wharf construction financing would have most effectively limited Olympia and York's exposure to the London financial services market contraction of 1990 and 1991? The case file is open.